Welcome back, everyone. Now that we have established how to structure our trading range mechanically, let's apply everything we have learned to a top-down multi-timeframe analysis. We're going to map out an institutional order block from the higher time frames all the way down to the lower ones to find our long-term bias. The yearly time frame master bias. Look at the chart to see our starting point on the macro view. If we look at the 12-month yearly chart of the US dollar index, back in 2001, a major bearish order block was formed. Fast forward to 2022, and you can see price rallied up and perfectly tested this exact yearly zone. Since hitting that level, the chart has been steadily falling. Notice the mechanical flow here. We had a clear inducement take place first. As we established in our previous lectures, we always need that first inducement to happen, and only then do we start hunting for our valid order blocks and fair value gaps in the remaining swing leg. This massive rejection gives us our strong macro bearish bias. Zooming down to the monthly chart. Now let's refine our view. Inside that massive yearly bearish zone, we want to look for a refined, nested setup. Look at the chart as we shift to the monthly time frame. Inside that bearish yearly zone, we wait for a fresh monthly order block to get created to give us our medium-term confirmation. Let's look closely at the candle structure here to mark it correctly. If you look at the candles responsible for the drop, candle 2 is completely contained within candle 1, meaning candle 2 is an inside candle. Because is an inside candle, we completely ignore candle 2. Instead, we combine candle 1 and candle 2 together, treating them as a single candle zone. Following that combined zone, we see a big momentum candle, a third candle, a perfectly valid FVG right below them. This locks in our refined monthly order block inside the yearly zone. Refining on the weekly time frame. Let's drill down even further to watch how price interacts with this zone dynamically. Look at the chart as we switch over to the weekly time frame. In November 2024, price rallies straight up and enters that refined monthly order block nested within the yearly block. I want all of you to pause the video right here. Look closely at this initial reaction point and ask yourself, is this a valid weekly order block? The answer is no. If you look right after that pivot candle turns, there is absolutely no valid FVG left behind. The wicks immediately overlap and neutralize the space. Since there is no institutional displacement or a valid gap, the trend has not changed here, and this is not a valid order block to sell from. Now, look at what happens next on the chart as price pushes a bit deeper. After some time, price prints another swing zone inside our higher time frame boundaries. This time, it is a completely valid zone. Why? Because it perfectly satisfies our 3-candle rule and leaves behind a wide, valid FVG right beneath it. Look at the result of that validation. As soon as that structural shift was confirmed, price had a massive, aggressive fall. With our long-term bearish bias fully locked in, we can confidently target that major sell-side liquidity resting at the bottom of the range. Understanding long-term bias and scale. Look at the chart for our final overview of this complete sequence. Keep in mind, we are still strictly focusing on how to mark out valid order blocks on real charts and how to locate your higher time frame bias. We will still learn about precise entry models in full detail later in this module. The most important takeaway today is that the concept of marking an order block remains exactly the same across all time frames, whether you're looking at a yearly, monthly, weekly, or a 15-minute chart. Once you train your eyes to find the true, long-term bias of a macro chart, you can easily step down to lower time frames to plan one big structural swing trade or execute multiple small, highly profitable intraday trades in the direction of that master bias. We will cover all of these lower time frame transition steps as we proceed further in the course. See you in the next lecture.